Welcome to today's class. Today, I just want to cover a concept in management accounting. So, I want to do a revision on MA, management accounting. And I want to do a custom past paper question. So, remember, MA or management accounting is in intermediate level. And this concept I'm doing is purely for the CPA students who are in that level, intermediate level. Though it is also applicable for those who are advanced, doing advanced management accounting. I want to do a concept called variance analysis. So what I'm covering today is variance. This is a very common area with CASNEB exams, and it's important to understand what is a variance. A variance is a distinction or difference between what is expected and what is the actual happening. That is what we refer to as a variance. You may have some expectations on maybe material costs, but after you purchase the materials, the cost may differ. So that difference in the expected cost and the actual cost of material is a variance. And that's what we call if it's in terms of the prices, it is the material price variance. We have different types of variances. We have the material price variance. We have the material usage variance. When you combine the two, the material price variance plus the material usage variance, that gives you the material cost variance. A variance may be favorable or adverse. If you had planned or you had expected to incur 20 shillings per kilogram of that particular material, then instead of incurring the 20 after you purchase the actual commodity material, the cost changes to 25 shillings. You expected to use 20, but now the cost per kilogram of that particular material is 25. So that is negatively affecting the company because the company is going to spend more on materials. So it will be an adverse variance, meaning it is negatively affecting the company because the company expected to incur 20 shillings per kilogram of material, but instead it is incurring 25 shillings. If it is the vice versa, then meaning you had planned to purchase a commodity or kilogram of material at 25 shilling, but instead you purchase it at 20 shillings. So you expected to incur more, but you have incurred less in terms of a kg of material. Then the total variance will be a favorable variance. It will be in favor of the company. It's going to help the company saving some cost. Remember, this is management accounting, which is about cost minimization. Well, so without wasting time, because today I want to do a revision, I want to do a past paper question, December 2022. There's a question which was examined there, question number 4B. And I'll do the whole of it because it is a revision, which is the block release, December 2022, question 4. December 2022, question number 4. So the question reads, part A. Part A, it's a theory question. Explain 4 arguments in favor of marginal costing system. Explain 4 arguments in favor of marginal costing system. Number 1, in marginal costing system, you can say there is no complication of over or under absorption of overheads. There is no complications of over or under absorption of what? Overheads. Again, if we use marginal costing, our selling price will be competitive. So you can say if used, the selling price per commodity will be lower. That's what? Competitive. So that is another argument in favor. Argument in favor is just an advantage to this costing method or the marginal costing system. Again, fixed costs are treated as period costs, and thus they will be incurred whether what production takes place or whether it does not take place. Another one is there that the concept of absorption is eliminated. There is no need for allocation, no need for apportionment, there is no need for also the allocation, apportionment, and the reapportionment. Then you can add another one and you say, it is used as a tool for decision making by managers. Managers, they normally use this concept for decision making. So those are some of the advantages of marginal costing. And again, it is used for internal reporting, plus any other which you may be having. So let's proceed to part B, which is a computation, a part of this question. It says Quarter Limited manufactures and sells a single product branded TT with a standard cost of shillings 1100, made up as follows. So you have direct material, which into bracket 15 square meters at 30 shillings per square meter, which is 450 shillings. Then direct labor into bracket 5 hours at shillings 100 per hour, which is 500. Variable overheads, which is 5 hours at 20 shillings per hour, totaling to 100 shillings. Fixed overhead is 5 hours at shilling or 10 shillings per hour, which is 50 shillings. Then we are told the standard selling price per unit is 1,300 shillings. The monthly budget project production and sales of 1,000 units. So it says the monthly budget project production and sales of 1,000 units. Actual figures for the month of November. So these are the actual figures for the month of November 2022 are as follows. So we have the actuals happening. Remember the above, which you have just read, that was just purely about the standards. Now we go to the actual happening. We are told sales is 1,200 units at 1320 shillings per unit. Actual production is 1,400 units. Direct material is 22,000 square meters at 40 shillings per square meter. Direct wages is 6,800 hours at 110 shillings. Then variable overhead was shillings 110,000. Fixed overhead was shillings 60,000. Required material price variance and material usage variance, that is Roman 1, 4 marks. Roman 2, labor rate variance and labor efficiency variance, which is again 4 marks. Then we have Roman 3, fixed overheads capacity variance and fixed overheads efficiency variance, which is again 4 marks. So that is totaling to 16 marks plus the other 8 marks, not 16 but 12 marks, because it is Roman 1, 2, 3, each 4 marks, that is 12, plus the first part of it, which was about marginal costing, which is 8 marks, giving you a total of 20 marks. And variance commonly examined. So let's start with Roman 1. So this is question 4. Now we are in part B. I start with the Roman 1. It has 2 parts, the material price variance and material usage variance. So I'll start with material price variance. We can abbreviate this one as MPV. So how do you get material price variance? This is the difference between the prices of materials. Variance is the difference between the budget or the standards and the actual happening. So if it is material price variance, it's the difference between the prices of materials. So whenever you start a year, as a company, you need to set your standards. You need to have your budget. That is what we use those set standards. What we expect to incur per liter of particular material, per kilogram of particular material. So we start by what we set at the start of the period, And because this is a difference between prices, I will start by the standard price. And this is standard price of material because it is material price variance. Difference between what? The prices of materials minus the actual price of material. This will give you the variance per 1 unit, then multiply by the actual quantity. Multiply by the actual quantity, and this is the actual quantity of what? The materials. So this is the standard price of the material minus what you have incurred the actual price of that particular material times the actual quantity of the materials. So what is the standard price of material? I'll come to where the standard is. The first part of the question said the standard cost of 1100 made up as follows. So this is about the standards. So we have direct material 15 square meters at 30 shillings per square meter. So the price, we are told direct material. So that is where you get the standard price. Is what? 30 shillings per square meter. So that is the standard price, shillings, 30 or 30 shillings. Minus the actual price. You need to go back or to go down there where you have the actuals. Remember, there is a place you're told here down. Actual figures for the month of November 2022 as follows. So this is the actual happening. So you need to see the price of material per square meter. I need to read. Bulletin 3 says direct material is 22,000 square meters. At 40 shillings per square meter. So the actual cost of that material is 40 shillings per meter. Then you multiply by the actual quantity of materials. Actual quantity, how many square meters were there actually? Direct material is 22,000 square meters. So multiply by the actual quantity of materials, which is 22,000 square meters. So you had planned or budgeted to incur 30 shillings per square meter, but instead you have incurred 40 shillings per square meter. So this is a negative because the cost has increased. The actual is this one. We had budgeted to buy a square meter at 30. Now it is 4 shillings. That's what you're buying at. It means this one is going to increase the cost of the particular, or in this particular organization. Thus, automatically, this variance is what? Adverse or negatively affecting the company. So let's multiply. 30 minus 40. 30 minus 40 is negative 10. Multiplied by 22,000. And I'm getting 220,000. And do not write negative 220,000. The reason is that negative here, we say it is now an adverse one. Into bracket you put adverse. Never write negative 220. No. It is 220,000 shillings, which is negatively affecting the company. Thus, it's an adverse variance. We go to the other part of the question. So that is 2 marks. We go to the other part. Material usage. Because Roman 1 was material price and material usage. Material usage variance. I can have MUV as material usage variance. This is how you're going to use what? The quantities of material. Usage is about how many kgs you're using, how many liters. So it is the difference between the usage and you have the standard quantity you're using if it's kgs. Minus the actual quantity. I've said we always start with the standards or the budgets. Then we less the actuals, multiply by the price of that particular material, the standard price. That is the formula. Remember, it is about materials. So this standard price is always the standard price of material, and it is the one which is here under the material price variance. So it shall be 30 shillings. Then we need to know the standard quantity we had expected to incur, less the actual quantity of material. Actual quantity is also here, which was 22,000. So what we do not have is the standard price. So we need to check into our question. We get the standard price. The standard price. So it says direct materials, we are told under the standards, per unit we are using 15 square meters. So I want to get the standards, the 15 square meters, the standard quantity. So times you go to the actuals, times you go to the what we produced, actually what was the actual production. If you want to get the standard quantity of material, it should be the standard set material usage per unit times the actual production or the actual production of the units in that particular company, which is we need to produce 1,400. that is a actual production, minus actual quantity of material, which was, we're told direct material, the AQ actual quantity is here, it was 22,000. 22,000, what are they? The square meters, they are square meters. Multiply by the standard price is here, so this is the standard price, 30 shillings. So let's get the standard quantity in total, 15, multiply by 1400, I'm getting 21,000. So this is the standard materials which you're expected to use. Instead, we have used 22,000. We have used more than what we had budgeted. So it is again negative or an adverse variance. So then less 22,000, you get negative 1,000 times 30,000. Sorry, times 30 shillings. Sorry, 30 shillings. I have 30,000. I have here 30,000. So I'm hoping I've done it correctly. This is 15 times 1400, 21 less 22,000, 1,000. Then we have the standard price of 30, yeah, times the answer, 30,000. So you will have here 30,000 shillings, 30,000. This is negative, so you don't write negative, you say it is what? Adverse. Assuming the examiner had asked you about the material costs variance. Material cost variance. You should have said it is material price variance plus material usage variance. So material price variance is where? Is here, which is an adverse of 220,000. Adverse, I can write A plus. Here we have material usage, 30,000, 30,000. Again, adverse. So you get the total. Get the total. So it should be 220 plus 30, which is 250. So this will be 250,000, which is adverse. So that is the material cost variance. If the examiner had asked you about the material cost variance. So you have your 4 marks up to here. After this 30,000, you have your 4 marks. Let me go to the other part of this question, part 2. We go to part 2 of this question. Well, so part 2 says labor rate variance and labor efficiency. Labor rates is Roman 2. Labor rates variance. I can have LRV. It's labor rate variance. It's the difference between the rates at which you pay the employees or the workers. The difference between the expected rate per hour and the actual rate per hour or per hour. So we read the question. Go to that question and check where we have the direct labor. And it is the difference between the rates. So if it's the difference between the rates, the formula will be the standard rates, because it's the difference between the rates minus actual rates. If you want to get the total variance, because if you need the total variance in terms of the labor rate, multiplied by the actual hours which they have worked, because this rate is per hour. The rate we pay employees is 10 shillings per hour, 10 shillings per hour. Meaning, we need to get the total variance multiplied by the total hours worked. So get the standard rates. We need the standard rates. We are told direct labor 5 hours at shillings 100 per hour. So the standard under the standard is 100 shillings per hour. Minus, we go to the actual. We go to direct wages, is where you can get how we are paying the employees their wages. Direct wages is 6,800 hours. That's the actual hours incurred. At shillings 110. So we are paying them 110 shillings per hour. Actual hours we have told here is 6,800. We had planned to pay employees or these workers 100 shillings. Instead, we are paying them the actual amount we are paying per hour is 110 shillings. This is states 100 hours, remember? So this is again negatively affecting the company. So you will have 100 minus 110, which is 10 negative, meaning it's adverse automatically. Multiply by 6,800, you get 68,000. So this would be shillings 68,000. But again, because it is a negative, it's an adverse one. Don't write negative as I've said. We go to Roman. It's Roman 2, but now labor efficiency is what examiner again needs. Labor efficiency variance, labor efficiency variance. How efficient you are, it depends with the hours you can perform a task. You are more efficient if you can do a particular task for a lesser period. So efficiency, it is measured in terms of hours. So it is the difference between the hours you work, and then it is the standard hours minus the actual hours. This is like the name of an individual. Who can pronounce the name? This is called Shah. Shah is name of a person. My brothers from the Islamic religion and also from Tanzania, they can bear me witness that Shah is somebody's name. I had a friend sometimes who was called Shah, Abedi Shah. So labor efficiency, that is how we get it. But you need to get the total. We are paying them the rates we had set, multiplied by the standard rate. Already the standard rate is where? Is here, 100. So this will be equals to what? Standard hours. Let's get the standard hours first. Here is my first paper. Let me look at it. Standard hours. It will be how many hours we need to incur per unit, which will go to the standard direct labor is 5 hours per unit, times how much production are we doing? 1400 production units minus actual hours is 6800. Actual hours already we had it here. AH is the actual hours, 68. Times the standard rate is here, 100 shillings. So that's how you get it. So first, let's get this standard hours. We see we had planned to pay for how many hours? So this is 5 multiplied by 1400. This is 7,000. But instead, we are paid for lesser period. It will favor the company because we are paying for less hours. This 7,000 hours, this 6,800 hours. So we pay for less. So this will be favoring the company. It should be favorable. Well, so minus 6,800, 7,000 minus 6,800. We have 200 shillings multiplied by the standard rate of 100 shillings. 100 shillings. Then I'm getting 20,000. So here we have 20 shillings, 10,000. This 20,000. This is favoring the company, so you write favorable, or you can write F. That is it. Roman 2, another for marks for that question. I want to go to the last part of it, the fixed overhead capacity, so that I can finish up the question. This 20 marks question for variance. Remember the past paper? You get it online. Don't even be worried. If you want to follow very well, you need to have your question paper. It helps you because it is online. You can download it and have your copies of that as we do. You can see where we're getting the figures. I want to go to Roman 3 of this question. The Roman 3 says a fixed overhead. So fixed overhead capacity, this is budgeted hours minus actual hours multiplied by fixed overhead absorption rate, which is per hour. Budgeted hours will be 5 because that is 1 unit requires 5 times. What you budgeted is 1,000. So we had budgeted to produce 1,000 minus actual hours of 6,800 times the rate, standard absorption rate is there. It's the standard 10 shillings. 5,000 is what we expected. 5,000 minus 68, so 5,000 minus 6,800. So this will be negative 1800 multiplied by 10, 18,000. It's negative, it's adverse. Efficiency I've told you is sharp. Standard hours minus actual hours. So times the fixed overhead absorption rate per hour. So remember, this is a fixed overheads, the efficiency variance. Efficiency is in terms of the hours, so standard hours, the short times the fixed overheads absorption rate per hour. Standard hours, we had worked it out. We said it will be 5 times the actual production of 1400 minus actual hours 6800. The absorption rate is 10. So this is 5 times 1400. I'm getting 7000 minus 6800. Then times 10, 2000. 2000 favorable. Because the hours we had expected to incur 7,000, we incur less. So it should favor the company in terms of the fixed overheads. So that is what was expected of you to get all the marks. So another efficiency here, remember it's not the standard, it's about the budgeted hours minus the actual hours. So look at the budgeted hours, how you can get them. You multiply by the units which you had budgeted to produce. You multiply by the actuals. We need the budgeted hours, but not the standard hours. Budgeted hours, not the standard hours, which is 5 times 1000. Thank you for watching. Subscribe to this channel so that you can support my YouTube channel. Thank you.